following is an update and technical analysis on crude oil, West Texas Intermediate futures based upon the daily interval where I'd mentioned on the 9th of September 2023, we're trading $87.51 a barrel, starting to retest, broke above the 85.72 price resistance, and we're backtesting 2 days in a row here based upon the 382 fibs retracement, call it 86.64 price resistance, additional price resistance. We were defended, crude bulls defended that key functioning level multiple days in a row there, and I had increased my perception in that previous video that we would start to stair step higher to retest the 93.73 price resistance, major, big resistance based upon the 50% fibs retracement. And it was a multi-year high, multi-reactionary high and low key transitioning point, and that would be the most valuable short trade setup and or full position short trade to the downside, only increasing the odds, especially if we had any technical momentum indicator damage below that key inflection point for a beautiful risk-reward ratio move to the downside if and when we went on to retest that key pivotal 50% fibs retracement zone. And here's the update. And really to the button, we never broke above solidly around that key inflection point, put in a nice clean R-side divergence, no validation of a green candle close up above it, and we ended up getting rejected impulsively, really to the button right off that key inflection point on the 19th of September there, especially if you're an active and or day trader. That netted you a 2.7% gains on a short trade setup to the downside. We ended up backtesting that key inflection point, consolidated briefly here, went on to retest this key inflection point. Again, never broke out above it solidly, had a whipsaw-like reaction, put a nice clean R-side divergent high with negative R-side divergence. And then we ended up slightly backtesting it on the 93.73 price resistance once again, put in a nice clean 3 black crow bearish continuation pattern. The entire trade thus far was good for, call it a 10.08% crash to the downside, double-digit crash move to the downside. And we are stair-stepping lower, testing now the 50-day moving average. And we are slightly undercutting it as of now. Well, we had some big, impactful headlines rock and cause significant turbulence within the crude oil markets, where we had the Biden administration continue to draw from the strategic petroleum reserve just as prices hit this price resistance zone, how the charts continuously manufacture the headlines. And that was just a beautiful catalyst right into that key inflection point. Not sure if the Biden administration and or the government are watching the charts, but talk about to the button right off that catalyst. Where additionally, there was a concerning drop in gasoline demand today, reaching levels not seen since 1997. We had that big, solid red candle close below. While concrete data on the situation deteriorated, optimism relied on more subjective indicators where crude oil took the spotlight as OPEC Plus members confirmed their production plans for the remainder of the year. Economic concerns completely outweighed fears of supply shortages, resulting in this and really the most substantial oil price crash since last September of 2022, where the UK gilt market blew up, had pension market completely imploding, where we even had witnessed an all-out reversal of stance from Governor Bailey of the UK, who initially hinted at a particular monetary tightening policy direction, only to retract the statement the following day with a casual, oops, just kidding, to completely save the pension market and gilt market. But rambling away, deep diving into the crude oil future posture of the commodity here, and we do have bearish crossovers here in the moving average convergence, which might retest and or regun to retest its zero line thresholds. You have the stochastics 1033 hovering up above, which could be potential support level right off this key inflection point where it has been defended heavily for multi-years on end here. And again, just we could have a counter back and or snapback counter trend rally based upon the 82.61 price support if when we go on to retest that key inflection point. And that, in my eyes, is the more imperative key inflection point for bull traders and or long traders to defend heavily if and when we go on to retest it for a snapback and or counter trend rally, revisiting the trough of April in 2023, with just a multitude of reactionary highs really across the board there. If there was any moment for a potential day trade and or snapback counter trend rally, that would be the ultimate key inflection point, which would come down to primary trading range, in my opinion, from what I see from this standpoint. This is where bull traders and long traders would really want to defend heavily at all costs to avert a much larger breakdown in the technical momentum indicators, but below their testing their zero line thresholds, and additional damage that could be inflicted heavily if broken down and breaking down right back into that key trading range. We take that level out, have a solid daily candle close below that key inflection point. I would only suspect a revisiting of the 78.98 price support, additionally the 77, even stronger support down at that 77.84 price support level, correlated with the 200-day moving average. And that would be, again, a multi-year of reactionary highs and lows to strengthen the validation of that key inflection point correlated with the 200-day moving average. Call it a dual line of price support. But again, just deep diving right back into this key trading range, and the odds are increased that you will retest the bottom of the key inflection point zone, the bottom of the trading range, if and when we go on to re-breach it and we had additional reactionary highs really across the board there. And that would be the ultimate level at the 73.20 price support there. If and when we go on, I believe if we break right back into this trading range, you're going to hear a whole ton of recessionary talk, and that could scare off a whole lot of leverage that needs to be washed out in the crude oil markets. As for the long trade setup, again, these are very aggressive long trade entry points. If and when I believe the most valuable long trade risk reward ratio setup to move to the upside would be near-term positive divergences found within the hourly intervals, and then a potential bounce off the 77.84. I love the dual support with the 200-day moving average. If not, the bottom of the key primary trading range right at that 73.20 price support would give me the ultimate, most valuable long trade setup to the upside, in my opinion. Where I had a minor reactionary uptrend line here, not too crazy about it, but again, we broke down below that key inflection point, which would also potentially identify a sell signal. And if we have a snapback and or counter trend rally here, this would provide an additional objective short trade entry, if not an add-on to your existing position, correlated with the 382 fibs retracement, for an additional move to the downside and re-challenging of the top of the primary trading range.